Well, good morning.
Good morning.
And welcome, Doreen. I'd like to introduce Doreen Walsh from Dominion Lending.
Yep.
And thank you for coming, everybody. Doreen, I know you know a few people in the room, but if you could tell us a little bit about you and your experience in the mortgage industry and what you're all about.
All right, well, here we go. Thank you, first of all, for having me. I really appreciate that, and for all of you taking the time out and being here. My name is Doreen Walsh. I am the Vice President of Network Development for Dominion Lending Centers. And I'm, look, here's what I say. All I know is mortgages. It's all I've done my whole life, right? I've been in this industry, let's just say over 25 years. And a lot of those years were spent on the lending side. So I will be celebrating 5 years at Dominion Lending Centers in June, which is crazy to me, but that has allowed me to marry both of my lending experience and now from the agent and broker side, dealing with clients, dealing with brokers, and what that looks like from being on the lender side to, again, being on the agent side where, you know, it's front facing and really assisting clients in growing family wealth and mortgages and explaining all of that. So yeah, that's what we're here to talk about today.
Doreen, you know, it's I've also been in the space for a probably similar period of time, let's just say over 25 years.
Right.
And mortgage brokers have gone from the periphery to right front and center.
Right.
Why do you think that's happened more so in the last 10 years than it did before then?
Look, mortgages are becoming harder to navigate, you know, and let's face it, it was brand recognition with the banks. You know, you're at the bank, your parents were at the bank, you tend to bank at the same bank your parents were at. So, you know, I think people were just moving forward, and mortgage brokers have become a lot more vocal about who they are and what they do. And I know Dominion Lending Centers has played a big role in that. We are one of the only brokerages in Canada to advertise directly to the public, letting them know exactly what our value proposition is, how we can help clients, and how we can help them, as I said, navigate the mortgage process. With, you know, 2008, I'm sure we all remember the credit crisis. There was a whole bunch of things that were introduced at that time. You know, the stress test. We went from, if you remember the terms insured and conventional, you know, nobody uses conventional today. It's insured, insurable, uninsurable. So looking at a rate today on a rate sheet doesn't mean that's your rate. You know, rates are dependent now on a whole bunch of things, and that's where the agent and the broker come in and, as I said, help clients navigate that whole process of getting a mortgage.
Not to give too much of a commercial to Dominion Lending, but no, I just something occurred to me on my way in this morning was that there's a lot of scrutiny with regulators
Yes.
around the real estate community, around the mortgage community.
Right.
Dominion has taken a big step by going public.
Right.
That puts a lot more scrutiny on Dominion Lending. How did their compliance change on the inside to make it fit into that box?
Right. Dominion Lending Centers has always, you know, obviously followed all of our regulators' rules around compliance, but we continue to do so in a bigger way. Being public means we have shareholders, you know, and not that having shareholders, again, changes how you follow the rules. We've just gone over and above, let's put it that way, as to what, you know, the regulators are asking for. And making sure that our due diligence is done properly, and any changes in regards to the regulations, we are on top of that day.
Great, thank you.
Mm-hmm.
I'm going to get into some meat and potatoes that we were talking about before,
Love it.
if that's okay.
Absolutely.
So traditional lenders, and I'm pulling this data from CMHC's year-end report on the mortgage industry. And some interesting data came out of it that I shared with you, and we wanted to talk about it this morning. So traditional lenders saw a slowdown in mortgage activity in the first half of 2023 as the housing market cooled. Interestingly, alternative lenders experienced the least significant slowdown amongst mortgage lenders and actually increased their market share.
Right. Right.
How do you explain that?
Well, bank lenders, even though OSFI regulates all of, financial institutions, there are some non-bank lenders that, have the flexibility to go higher in GDS and TDS and perhaps take non-traditional income, like Airbnb income, different sources of income that they can use. So as rates started to rise, what everybody forgets is, a couple of years ago, well, not a couple, again, in 2008, when they introduced the stress test, that was to give people the comfort that if rates were to rise, they would still be able to manage the increase in mortgages. What some people forget is people also accumulate debt during that time. So now we have your mortgage payment, we have the rise in rates, and we have some accumulated debt. So, when some people came up for renewal, they're looking at, all right, let's see if I can go to my traditional bank and get a refi. Well, now they don't qualify. So those people are going over to your non-traditional lenders. Somebody purchasing a home, again, if you have less than 20% down, you have to follow the insurer's guidelines. If you have more than 20% down, that's where you can take a look at going to traditional lending, going to alternative lenders, mix, privates. You have options, and those options, obviously the higher the risk, the higher the rate, but the more flexibility you get.
So you just made me think of something, the renewal right now. Mm-hmm. So if you are not in default,
yep.
If nothing's materially changed in your personal situation, and it's time to renew, and it's a new rate,
yep.
What happens?
So most A lenders don't pull a credit bureau, they just offer a renewal. And then some of your alternative lenders in regards to re-looking at the application, whether they want to go through. Here's what I'm going to say about renewals. And yes, I'm plugging Dominion Lending Centers because they do it right. When I left the lender side after all those years, I could have gone to a number of different companies, and I choose Dominion Lending Centers for that reason. They have started a new program called Gold Rush. And this is, different touch points with the clients to remind them, do not sign your renewal. Go in and sit down with your mortgage agent or broker and have that conversation. Mortgages aren't just about rates. There's a whole contract behind that renewal. And, there's different options that the public is not even aware of. We have a huge amount of mortgages, billions and billions and billions of dollars coming due over the next couple of years. And again, my suggestion would be to sit down with, your Dominion Lending Center agent or broker and have that
That's
conversation.
what editing is for, don't worry. Do you think there's a common belief that if the rates changed, it's not what you qualified for before, you better just sign it and renew rather than ask questions?
All right, let's take a look at that. Now we're going to pull back the curtain. Mortgages aren't just about rates. When you sign that commitment, that 1 or 2 page commitment, don't forget when you're going to the lawyer's office, you will also sign something called standard charge terms. Most lenders, lenders have between 21 pages to 32 pages that exist in those standard charge terms. Rates might be on 2 or 3 pages. What is on all the other pages? And this is where we come into penalties, prepayments. Mortgages are product pricing like anything else. You pay for what you get, and sometimes a rate that is there isn't so great when you have to move or pivot. I always say, in some lenders' cases, there's 2 rates on a mortgage, the rate you're going to get going in and the rate you're going to get going out. So let's take, some of the banks where they have posted rates. And you always see that posted rate there, and then you'll see something that says either special or discounted. You're going to get that discounted or special rate. But if you go to their standard charge terms, when you break that term, the standard charge term says right in there, you will compare the rate to, if you're breaking a term you've taken a 5-year term and you're breaking it at 3. If there's 2 years left, you're going to compare your rate to that 2-year rate, and add back any discount or special that you received at the time of funding. Now the comparison goes from here to here. I mean, has anybody heard of people paying $20,000, $30,000 in a penalty?
Absolutely.
Yes, absolutely. That's why. Please sit down with your agent and broker when you get that renewal, because these are the things that you want to talk about. They talk about an interest rate differential. That's what you're going to pay on. An interest rate differential of what? The 3-year bond, the 5-year bond, prime Bank of Canada prime rate, the bank's prime rate, because some of them have their own prime rate as well. That's an incomplete sentence to me. So you have to know that that mortgage works for you today and tomorrow. And that's sitting down and talking about that contract and all the little nuances that you need to know about it.
I would submit that most people never thought about it's the existing posted rate that they're comparing against when there's an interest differential. So for those people who aren't familiar with interest diff, it really doesn't matter too much when rates are going up or when they're stable. But when you've locked into a rate at X and now today's rates are Y and you want to break it, you're paying the difference of the interest that you would have had to pay had you kept the mortgage for the full amount. And admittedly, I didn't know until we started talking that it wasn't the rate I got that they calculate the interest differential on. It was the posted rate at the then time.
Right.
Which could be an arm's length more than you even dreamt
Right.
of. Thousands of dollars.
Tagging on to what you just said, I had said earlier there's billions of dollars coming up for renewal. Rates are high. Look, none of us have a crystal ball, but I follow some pretty top economists in Canada, including Sherry Cooper, our own economist at Dominion Lending Centres. And what they're all saying is, obviously, rates are coming down. We are headed down. We've plateaued. Tiff himself is agreeing with that. It's just a matter of when and how much. We saw rates go up every quarter when the Bank of Canada met, and sometimes they would go up a quarter or half a point. Rates won't come down that quickly. They'll come down a quarter, and maybe not necessarily every quarter when they meet. They may skip a quarter, come down half a quarter, but we do know they're coming down. So if rates are here today and they're coming down in 2 years, what looks like a great rate today is not going to feel like that in 2 years. Here's the problem. You'll say, hey, let's go in and renegotiate our rate, or we want to move, or we want to do something. Now that rates are down, but your posted rate from way back here, now you're going to be paying some penalties. And it's not just posted rates, don't get me wrong. There's all sorts of different lenders out there. Some of the lenders, if you deal with alternative lenders, or even if you're dealing with a private, a lot of those short-term lenders, and I call them short-term because privates mix, they look for offering terms of a year or two. Because the point of getting that mortgage is you're in that mortgage for change. You're buying time, you're looking for change. So you're hopefully going out of there. Some of those don't renew. You need to know that when you're taking a mortgage with them, because all of a sudden it's like, oh, I'm not getting a renewal. Now I've got to go to another high-risk lender. That means more fees, perhaps another appraisal. Perhaps things have changed. So there's questions on all of these contracts that we have to be aware of. And the general public normally looks at the front-facing, how much am I getting at advance? What's my rates? What's my monthly payment? They're missing all the pages in the book.
Wouldn't that be a surprise, getting a payout statement versus a renewal statement?
Right?
Without plans.
Absolutely. Yeah. And I mean, at my years as a lender, I can tell you right now, clients selling their home, breaking their term, and looking to, upsize, change, whatever that reason is. Over the years, I saw a whole lot of clients who not only were shocked, but now didn't have the down payment they needed for the new purchase.
There's a large portion of our realtor population that hasn't seen a rate change going downwards.
Right.
from a higher rate. It hasn't happened in a long time.
Right, right.
And so my favorite two words are mortgage verification. When you're taking a listing, it's time that we really pay attention to that so that we know exactly what the seller's equity is going to be on their way out.
Right.
Because they could be shy. They might not be able to make the move. They might not be able to pay commission, lawyer's fees, any other expenses because they have a gap in their penalty that they thought. Because a lot of people think, oh yeah, it's 3 months or things like that.
Right.
Because it's not really properly explained at the table. And so I think, and I know that's low-hanging fruit for you, for compliance, is that is there an explanation tool that the big six, actually I should say the big five, because HSBC Canada just got bought by Royal Bank.
Right.
So the big five, is there sort of a template that they say like people have to initial on areas that affect those things? Like you would think there would have to be.
Well, this is easy. Did you have to when you got a mortgage? I know I didn't.
I was just grateful they gave me one.
Right. I always say that's exactly it. People are so nervous at purchase. I'm in the industry and I'm nervous when I buy and sell. I can't imagine the layman who knows nothing about mortgages. You'll get the answers to the questions you ask. That's the key, and that's what I say about mortgage agents and brokers. It's our job to provide the answers to the questions clients don't even know to ask. And that's where IRD is hidden. That's where penalties are hidden. Nobody is talking about a posted rate. You think there are terms like specials or discounts. Those are those words that give us that warm and soft feeling that I got the special and I got the discount. I'm so happy. Never, ever, ever. And I've purchased a number of homes. Has anybody ever said to me, oh, and by the way, well, that special or discount will come back into play if you go to break the term? I've never had the conversation. Right. Crazy.
So, not to come down hard on big banks or anything.
No.
However, so let me give you some interesting stats that I know you're aware of, but probably everybody isn't. So, market share of outstanding mortgages. Big banks. What percentage do you think big banks have of outstanding mortgages right now? What do you think?
80?
The big six? 80? Anybody else? 73%. 73% of current outstanding mortgages. So credit unions have 13%, which is a bit of a lift than it was in the past.
Right.
Other significant ones is other chartered banks, other than the big 5 or 6. So far we've got close to 80%, which are banks, and then the rest are mortgage investment entities, other non-bank mortgage lenders, and non-bank but OFSI regulated lenders, which is a really small portion. So these sort of things we're talking about are 100% commonplace with all the major financial institutions, correct?
Absolutely.
Okay. So here's something interesting. Of newly extended mortgages, the market share the conversation changes. So with newly extended, the big banks only are 54%. So I'm not sure how to interpret that, but it's a big shift from outstanding.
It's about qualifying.
It is.
Absolutely.
So,
going
because I see the market share changing. So credit unions go up, non-investment, mortgage investment entities go up, non-bank, other banks, other chartered, non-bank OFSI regulated, they've all gone up.
Right.
So what's happened?
Well, let's face it, it is about having, as I said, using that alternative income that maybe your chartered banks won't use, or the flexibility in GDS or TDS. Borrowers who are business for self with a stated income program. Now, don't get me wrong, the banks do some of that too, but there's only so much flexibility. We are seeing an increase in alternative lenders because of the environment we're in right now and people qualifying. I do want to go back to something where, we talked about not to pick on the banks. I'm talking about all lenders, when I said earlier, mix not renewing, or just, everybody needs to know what they're signing. We love our banks, we need our banks. And I'm not against penalties. I'm against penalties that are shocking to people and take a lot of their equity. I'm against people signing contracts that they don't understand, have not read, or not been explained. We need all of our lenders in Canada. We love our lenders. Again, our banks, our non-banks, our mortgage finance companies, credit unions, mixed and privates. But people shouldn't be selling products that they don't completely understand, and clients shouldn't be signing contracts that they don't wholly understand.
Yeah,
That's my message.
To be fair, I mean, part of the reason we have such a stable and well balanced economy, and in even the worst cases, is because we do have the stability of the big banks.
Right.
And they're governed, and they have to be very careful and all this stuff. But the truth of the matter is, these are conversations that they're not having with the clients on large, and we should be, because if they're not, we need to, because it'll affect them right at the street level. The financial institution doesn't feel the street level of the client.
Well, it's funny, if you walk into, your bank 20 years ago in my neighborhood, okay, who's kidding who, more than 20, when I grew up at home, let's face it, you walked into the bank and everybody knew Mary. Mary was the lender. Mary had been there for 20 years. That's not the case anymore. People, first of all, sell many products in a bank, and they do move around. Sometimes you can go back in and 6 months later, the person you dealt with is not there. So when I advocate for the agent and the mortgage broker, it's because they're not there for the transaction. They are in that mortgage until you are out. And they will help you navigate that, understand the contract, see what you're signing, make sure that the product that you're getting into works for you today and tomorrow. And mortgages is all they do. So there is a difference. They are subject matter experts when it comes to mortgages, and they deal with different lenders and are aware of the different policies. So, talking about the mortgage as a whole, talking about the contract, not just the rate. The rate's the attraction, the contract's the personality.
So something you made me think of with the non-renewals and the why alternatives have started to go up. What's been the impact on a lot of condominium corporations not permitting Airbnb use?
Well, Airbnbs have gotten a tough rap in the news. Look at everything has some ugly stories attached to it. I think there's, first of all, people buying condos want to live with other people who live in those condos. It's pride of ownership, right? I take care of my condo, I want you to take care of your condo. So there's a couple of things with noise control, people coming in and out. The whole reason for having a concierge or those different steps in a condo where you have pass cards, it's all about security. So that is the one thing it takes away for a lot of the people living in those condos, is that sense of security. The other thing is, as lenders, if everybody buys into a condo and next thing you know, that whole condominium unit is not owner occupied, that becomes less attractive to a lender because it's a higher risk. And again, it comes down to pride of ownership. It comes down to taking care of the property. So there's different elements attached to that. And I mean, we can go down this road a long way, right? Obviously, it affects our city and our hotels and all the different things that we're trying to bring in regards to attracting people and the rest of everybody making money. Our hotel industry, our service industry. But from a lending standpoint, it does come down to, you don't want the people who own the condos don't want the Airbnb condos for all those reasons, and lenders don't love when a condo is, not owner occupied. Of course you can have tenanted condos. If it's 80% tenanted, that changes the game.
So I agree with you completely.
Yeah.
My question further to that is, what about the income that the buyer qualified on, who now has a rental property that they counted on having an income here, and now it's time for renewal and their condo no longer permits Airbnbs? Are you seeing an impact in the market with that?
Well, first of all, as I said, the banks never used that income anyway, the Airbnb income. So that's going to be a different type of lender. And we've not seen that
yet.
I'm sure it's happened, right, but it's nothing that would impact stats, let's put it that way, so how that plays out in the next couple of years, maybe it will be a point of conversation. But right now, I guess if people relied on Airbnb, maybe if it's a rental, they might have to go with full-time rents.
Yeah.
We see a lot of people who were renting that now the rental's not covering the mortgage payment, right? So the next thing they're looking to is how do we get students in, turn these things into a multiple rental situation. But there again, a lot of lenders don't do rooming houses or student rental because, again, it comes down to ownership of the property and taking care of it. Don't forget, that's their collateral, right? So they want to make sure that the property itself is being taken care of.
Yeah, it might be a good project for a real estate agent to figure out which buildings have not outlawed it and do a little prospecting.
Right.
Because, I mean,
right.
if I bought something and I was expecting, $4,000 or $5,000 or $6,000 in cash flow every month, and now I was getting $2,500.
Yeah.
I might rethink my plans.
Absolutely.
So speaking of, we're into mortgages today. So I have a few questions for you.
Yep.
Why do you think people ask more questions when they're going out to lease a car than they do and they're worried about the kilometers and and all these things, and they scrutinize this thing so much at a car dealership, and they're worried about getting, for lack of a better word, screwed over or getting tied into something, but they're just so anxious to sign everything off with a mortgage, and nobody reads all those documents.
Right. I've talked about this for years, I've never worked at a car dealership. I've never sold a car, sold a lease in my life, but I know walking in there, I have about 10 questions, how much is the car? Okay, can I get a loan for that? Can I get a lease? What's the residual? What's the residual payout? What's the warranty? Can I get an extended warranty? How many kilometers? On and on and on. And people walk in and go, what's the rate? At something that's 10 times the price of a car, Although maybe not these days. I've heard buying a car is outrageous. But anyway, right. It is just the rate because they don't know to ask anything else. The lending industry as a whole, and I'm talking about everybody, we've not done a very good job of, informing the public all the different aspects of a mortgage. Everybody talks about a rate, and that rate can be smoke and mirrors. So if somebody says to me they got a great rate, I always think in my head, I got about 10 more questions, and then I'll let you know if you have a great rate.
That's a good response.
Yeah.
But I would say most of us in the audience would think that mostly the customer's thinking about rate, and that's what they talk about.
Right. It's all they know to ask.
So explain posted and why they actually advertise the posted rate versus why not just advertise the best rate?
Well, again,
when you look at the banks, the institutions, they're saying 5-year closed. These are all the rates, but those aren't really the rates. Those are the posted rates.
Okay, so I will tell you, I did a little project myself and called up a bunch of different places and asked them, I looked at your rate sheet and I see that, you've got this special and then you've got this posted rate. What, I don't understand, which rate am I gonna, listen, most of our clients qualify for the special rate. We just look at that as a reference. I'll get another answer like, it's just something we use in regards to profile, but most clients qualify for the special rate. I'm trying to remember some of the responses I got. Not once did I get the response saying, well, that'll be the rate we use when you pay out. Not once. And I'm not sure, maybe there's a posted rate there for another reason, but I don't know it. But that posted rate is right in the standard charge terms, saying please add back any discount or special you received at the time of funding to calculate your penalty.
Now you call them the standard charge terms.
Yep.
Is there any possibility of having those altered?
No.
If someone does read it?
I would not say a bank's going to alter their standard. Like if you put a line through it and just said, 5%, If you get it, let me know.
Well, I'm a real estate broker. I give the bank
no.
a sign back.
Hey, it's time to negotiate. Pull your sleeves up. You're probably not winning.
Yeah, you're probably right. So what would you say, I don't know if you have this sort of percentage or not, but if you look at the whole mortgage community, how many go, percentage-wise, how many don't go to full term and need to break early?
Well, it's funny. I had done this talk nationally for Mortgage Professionals Canada, going out and speaking about, here's how this works, here's how that works. And when you talk to any of the lenders, they will tell you, oh, we don't track those numbers. I don't believe them. So you're not tracking if you're losing money or, right. I do have some friends in some places, and made the call, and I will tell you, one financial institution had 10,000 mortgages pay out in that year. Of the 10,000, 2,000 were at maturity. 8,000 of them broke their term. That equates to 80%. Am I going to tell you every year it's 80%? No, I'm not. But I can only give you the stats that I received. On the B side, lender shared with me that, and again, remember, when we're talking about the B, the alternative lending, a lot of times it's only terms of 1 and 2 years, right? They get between 11 and 15% of people breaking the term. So if I'm signing, think about that. For 1 year, I'm signing going, okay, I'm buying some time, waiting for change. I know in the next year what I'm doing. It's hard to do a 5-year plan, but I'm pretty good in the next year. If 15% of people, 11 to 15, are paying out in the first year, how many are paying out in the second? How many are paying out in the third and the fourth? We're not our parents anymore. We don't stay at jobs for 30 years. We don't stay in homes for 30 years. We don't stay married for 30 years. So we're changing, and every generation changes even quicker. People want to, they change nobody signs a 5-year term going, oh, I know I'm leaving in 2.5. Nobody. So in that year when 80% of those people broke that term, they broke for a reason. Divorce, upsizing, downsizing, job loss, illness, debt, investment, whatever the case is, they were moving, their life was changing. And so that's where I say you have to have a mortgage that will work for you today and tomorrow in the case of a change.
So as a strategy from a lender, a FI, a financial institution, is there a strategy for best rate or best discount for a certain term versus another? You see some variance in it, and you wonder if it's tied to the bond rate, if it's tied to what the break rate is.
Right.
This causes you to ask questions, and it's not that we can really do anything about it, but this is all about education to our clients and saying, hey, just ask the questions, because if something changes, you need to know what you're doing,
right,
and in advance of doing it.
I will give you an amazing example. Clients went out to see a broker and went into a term with a higher risk lender, because that's where they needed to be. That's where they were qualifying. And, we always say, look, come back and we'll revisit your situation. We'll take a look. Can we put you over on the A side? Can we do this? Or what do you need? And that client came up for maturity and never called the broker or the agent and renegotiated the terms directly with the lender. Well, the lender, they had to break that second term, and their penalty was $48,000, because the commitment says, the commitment had outlined the penalty, but when you go to their standard charge terms, which I personally did, it said, please refer to your commitment for the prepayment rules, which means every time a commitment's issued, the rules can change. That's my point. It's again, this isn't about just bank. This is about all lenders. This is about signing contracts. This is about getting that help to navigate those contracts because there's no standard IRD. There's no standard payout. Every lender has the right to charge, you know, well, with obviously not passing the laws, not passing usury, but the right to charge the penalty that they decide, and they're fully disclosing that when those documents go to the solicitor's office. Nobody's reading them.
It almost sounds like you've got a different set of questions depending on the lender you're dealing with.
Absolutely. Well, they can be the same questions, but you got a different set of answers. If I'm signing a mortgage, I want to know what my rate is. I want to know how I can make my payments bi-weekly, weekly, monthly, quarterly. I want to know how the interest is calculated. You know, if it's a variable, is it monthly? Is it semi-annually? Is it annually? What's my payout if I need to get back? Break the term. And this is where I say a lot of the general public don't know the questions to ask. This is why we should be going to the pros. Brokers and agents are on your side. They're looking at the contract to see how they can get you that best contract and that rate. They don't work for the lenders. They work for you. Yes, their lenders are their partners and they are going to take care of them in regards to compliance, in regards to following the rules, making sure that, you know, everything, that all the documentation you have provided is correct. But where it comes to making the best decision, they're making that decision for you.
You know, in this environment, this is where we can blue sky stuff. So when we do a deal conditional on status approval by the buyer's solicitor,
Right.
you wonder why the buyer's solicitor doesn't review the standard charge terms for the client.
Yeah, they don't.
You
And
know,
again,
on a private they do.
Well,
On a refi, on a private, they do things like that.
Right.
And they'll say, hey, did you know? Did you
Right.
know? But when it's standard bank terms, it just kind of
goes, right? Because,
Goes.
you know, that MIC is dealing with that lawyer. And by the way, when you deal with the MIC or the private, you have two separate lawyers, right? Because there's going to be a lawyer for the client and a lawyer for the MIC. They really want that to be clear on the contract that
Can you
were
clarify
signing.
what MIC stands for?
Mortgage Investment Corporation. So MIC is, they're almost this, well, I shouldn't say they're the same as a private. They're not the same as a private because they do follow the guidelines. And one of the guidelines that they follow is ensuring that they know their client. They ensure suitability. You know, if you're an investor with a MIC, you know, you have to sign, am I high risk, am I low risk, am I medium risk? And obviously the risk, if I'm lending out my, you know, putting my money into the MIC for investment, they're going to lend it out as my risk tolerance. If you need to borrow money from the MIC, they're also going to take a look at, okay, what is your risk? And if you're a lower risk, you're going to get a lower rate. If you're a higher risk, you're going to get a higher rate. When you go private, sometimes, you know, it's, hey, I got money and you need it. That's not, you know, suitability. That's not knowing your client. So there are MICs out there, and there's some wonderful MICs out there. But again, that then becomes a different set of questions, right? In regards to, do you renew? You know, we don't ask banks if they renew, and people know they renew, but not all MICs and privates renew. So that's where your agent will help you, again, navigate those terms.
So the best rate isn't always the best rate.
Oh, no.
So I'm going to put you on the spot. We're going to go easy. So if you had to advise the marketplace now, and as agents representing clients and mortgage brokers representing the same clients, if you're a first-time buyer, what would be your strategy right now in the marketplace?
So first-time buyers, you know, that it depends on your first-time buyer. Some first-time buyers get a huge inheritance and have a very low loan-to-value. Some first-time buyers are...
Let's talk about all the other ones.
Skint on closing, right. Well, we have a variable and we have the fixed. And I always say first-time buyers are going to go through something called payment shock, right? You're going to be living at your parents' house as what? They live there now till they're about 40, is that right? So you're going to go from either paying no rent or a little rent and your internet to moving into a house. Now you know that you've qualified on your mortgage payment, on your taxes, and on heat, which is never the amount of heat that you're actually going to pay. But on top of that, so now you're going to have Enbridge. Now you're going to have, your utility bill. Now you're going to have maintenance on the inside of your house, the outside of your house. Now you're going to have to furnish it. You're going to have other bills. Most people moving in don't have a shovel, a rake, a lawnmower, all the things they need. That's what we call payment shock. You go from 2 payments to 10. So in a lot of cases with first-time home buyers, picking a fixed rate will allow you to know exactly what your budget is. Whereas if your with your GDS and TDS being tight, because sometimes it's hard to absorb, those increases in rates with variables. So that's one thing. So again, it's knowing your client and knowing whether. Another thing is, so the variable right now, in contrast to a fixed rate, the percentages has gone down. I'm not sure what, it might be an 80-20. I don't even know, and don't quote me on that. But a couple of years ago, it was 50-50. 50% of the people were taking variable and 50% of the people were taking fixed. So we still have fixed. 50% of people are like, oh, I don't like the variable, it scares me. If you can't sleep at night taking a variable, don't take a variable. So right, the first-time home buyers, between understanding that you are going to come across that payment shock, I'm still not saying you should take a 5-year. Maybe you take a 3-year right now, because we are watching where rates are decreasing in the future. So you do want the flexibility of perhaps going into a lower rate, but I hope that answers your question.
It does. And so move-up buyer who's got equity believes in that rule that says if you stay variable through the course of a mortgage, you always come out ahead. Do you think that's still true?
Well, I hope so. But again, we don't have a crystal ball.
Right.
But I listen to some really great economists, and their advice is right now to, yes, either take the variable, we know rates are going down, or take a shorter term, because you want that flexibility in the future to be able to pivot into perhaps a longer term or into something. But right now, locking in at these rates at a 5-year term,
probably not.
You're not going to get the benefit of the future change.
Right.
Right.
Got it.